Hello, and welcome back to Reflections on Investing. Last time, we reached a surprising conclusion. Investment managers that have good track records, that is, who outperformed in the past, tend to do worse than investment managers with bad track records, who underperformed in the past. This is clearly different than virtually everything else in life. Great golfers, great tennis players don't tend to underperform amateurs in the next year. So why is it different in investing? And the reason was price. That what happens when an investor outperforms is that the prices of the securities that he or she is holding have risen. And when an investor underperforms, the prices have fallen. Therefore, going forward, if those investors tend to buy the same types of securities, the outperformer is buying expensive stocks and the underperformer is buying cheap stocks. So, in our view at the Cornell Capital Group, looking at past returns or past performance simply is not a very good way of evaluating or choosing an investment strategy. Well, then what is? And I think a good clue to that is a quote from Warren Buffett. He's really paraphrasing Benjamin Graham. And he says, when you buy a stock, price is what you pay, value is what you get. And at the Cornell Capital Group, we believe this in spades. The key to our investment strategy is a comparison of price and value. Now, in the current market, I think many investors haven't paid much attention to that. They've bought securities with the idea that you can sell them for more in the relatively near future. And since the bottom of the initial COVID drop, that's been true in spades. That's worked great. You buy, the market goes up, you sell, you get back in, you make more money. This has been the result of a unique bull market that has been supported by ever-accommodative Federal Reserve policy. But the problem is it's not a real long-term investment strategy. It is what we think of as speculation. If you are buying to sell to someone else, you're not really investing, you're speculating. A good question to ask yourself is, what if I had to hold the securities that I've bought for 20 years? Would I be comfortable? Would I believe that they were going to pay out sufficient cash flow to justify the price that I'd paid? Consider GameStop, for example. You may make money buying GameStop today and selling it next month. But would you make money if you bought it for now and held it for 20 years? And by make money, I mean make a reasonable rate of return. It seems unlikely. Therefore, our answer at the Cornell Capital Group is that you cannot judge an investment strategy by past track records. It's just misleading. All you can do is evaluate the extent to which that strategy is reasonable going forward. And in our view, the only reasonable active investment strategy is a careful comparison of price with estimated value. Thanks so much.